Picture this. It is late summer 1998. Markets look calm on the surface, then Russia defaults on its debt, and suddenly the safest trades in the world start moving like penny stocks. Spreads blow out, liquidity disappears, phones ring, margin calls hit, and one of the most famous hedge funds ever built, long-term capital management, starts to fail in real time. The question I want you to sit with is simple. How does a fund run by Nobel Prize-winning economists and elite traders get so close to wiping itself out? I am going to use LTCM as a mirror, not to laugh at smart people, not to pretend I am immune. I want to pull out lessons that matter if you trade options, buy index funds, run a small business, or just want to retire without getting wrecked by one bad decade. LTCM was built around relative value. That means they were not betting that stocks go up or down. They were betting that two related prices would move closer together. Think of a cheap bond and a similar expensive bond. They expected the difference, called the spread, to converge. Spread is just the gap between two yields or two prices. In normal markets, those gaps do tend to mean revert, which means they drift back toward typical levels over time. The problem is that convergence trades often look like free money right up until they do not. The returns are small, so you add leverage. Leverage means borrowed money or borrowed exposure. It magnifies gains and it magnifies losses. LTCM used a lot of it, not just simple borrowing, but derivatives and repo financing. Repo is short-term borrowing against collateral, usually bonds. It is cheap in good times, and it can vanish in bad times. Here is the first lesson. A strategy can have a positive expected value and still be lethal with enough leverage. Expected value is the average outcome over many repeats. It is a long-run concept. Your account lives in the short run. If you cannot survive the path, the long run does not matter. LTCM was exposed to volatility. Volatility is how much prices swing around. Most people think volatility is the risk. It is not. Volatility is the speedometer. The real risk is drawdown and ruin. Drawdown is how far you fall from your peak. Ruin is when you cannot continue because you are forced to liquidate or you lose access to funding. In 1998, the issue was not only that spreads widened, it was that they widened fast and everyone wanted out at the same time. That is liquidity risk. Liquidity risk is the risk you cannot sell at a fair price when you need to. You can be right about value and still get destroyed by the timing of cash needs. This is where market structure matters. Market structure is how trading actually happens, who the natural buyers are, what dealers do, how funding works. In a crisis, dealers step back. Balance sheets shrink, haircuts rise. A haircut is the extra collateral lenders demand. When haircuts rise, leverage collapses. That forced selling pushes prices further away from fair value. That is reflexivity. Reflexivity is when price moves change behavior and behavior changes prices again, creating a feedback loop. LTCM was not alone. Many funds had similar positions. That is crowdedness. Crowdedness means too many players are leaning the same way, using similar models, financed in similar ways. In calm times, it looks like confirmation. In stress, it becomes a trapdoor. Another lesson is correlation. Correlation is how much two assets move together. In normal times, some things diversify well. Diversification means you spread risk across different bets, so one loss does not sink you. But in crises, correlations often jump toward one. Good diversifiers can fail right when you need them. In 1998, many trades that were assumed independent became linked through funding and forced liquidation. It was not just that assets moved together. It was that people sold what they could, not what they wanted. I want to connect this to something normal adults can feel. Imagine you own 2 rental properties and a small stock portfolio. On paper, you are diversified. Then a recession hits. Tenants miss rent. The bank tightens lending. Your stocks drop. You are forced to sell stocks to cover the mortgage. Now the assets are linked by your cash flow. That is the same pattern. The link is funding. LTCM also teaches humility about models. They use sophisticated math and historical data. That is not the sin. The sin is forgetting the limits. A model is a map, not the territory. Risk is what lives beyond the model. Tail risk means rare, extreme outcomes that happen more often than a normal bell curve suggests. Russia defaulting and the global scramble for liquidity was tail risk. It was not impossible, it was just underweighted. This is where base rates matter. Base rates are the historical frequencies of events. If you look at centuries of markets, you see defaults, panics, wars, policy shocks. They are not anomalies. They are part of the distribution. The exact trigger changes. The pattern repeats. There is also a behavioral finance angle. Behavioral finance is how human psychology affects decisions. Success breeds overconfidence. Overconfidence is when you overestimate your skill and underestimate uncertainty. LTCM had a strong track record. The market rewarded them. Banks competed to lend. That is incentive risk. Incentive risk is when people get paid for taking risk today, while the blow-up cost comes later and lands elsewhere. You can see the same failure mode in rogue trader cases like Nick Leeson at Barings. Different strategy, same control problem. Weak oversight, hidden exposures, and a culture that confuses profits with risk control. In Leeson's case, it was unauthorized positions and deception. In LTCM, it was authorized positions and shared belief. Both show that risk is not only about the trade. It is about governance, transparency, and the ability to say no. A key point is that LTCM was not just making directional bets. They were making bets on convergence, which is like selling insurance. Selling insurance tends to earn small, steady premiums. Then occasionally you pay a huge claim. That is negative convexity. Convexity is how your gains and losses change as the market moves. Negative convexity means losses accelerate when markets move against you. Many levered relative value trades have that shape. They look stable, then the floor drops. Now, think about position sizing. Position sizing is how big you bet relative to your capital. It is the quiet driver of survival. The Kelly criterion is a formula for sizing bets to maximize long-run growth. In plain language, it says bet more when your edge is high and uncertainty is low, and bet less when uncertainty is high. The catch is that Kelly assumes you know the true probabilities. In real markets, you do not. So full Kelly can be dangerous. Many pros use fractional Kelly, which means deliberately betting smaller than the math suggests to reduce the chance of catastrophic drawdowns. That idea, betting smaller than you can, is not conservative. It is rational under uncertainty. Uncertainty means you do not know the true distribution of outcomes. Risk is what happens when you are wrong about that distribution. One of the most practical lessons from 1998 is stress testing. Stress testing means asking, what happens if the world looks like the worst historical weeks, or worse than history? What happens if correlations go to 1, funding costs double, and you cannot exit for days? If your plan assumes continuous liquidity, it is not a plan, it is a hope. Another lesson is concentration in hidden form. LTCM had many positions, but many were the same trade with different labels. That is factor concentration. A factor is a common driver like credit spreads, volatility, or funding. If most of your portfolio depends on tight spreads and easy leverage, you are concentrated even if you own 100 instruments. I also want to talk about the bailout, or more accurately, the private sector rescue coordinated by the Federal Reserve Bank of New York. The point is not morality. The point is system risk. System risk is the risk one failure cascades through the financial system. LTCM had positions with many counterparties. Counterparty risk is the risk the other side cannot pay. When everyone is connected through derivatives and funding, one forced unwind can hit many balance sheets. This matters today. You might not trade swaps, but you live in a world where plumbing matters. The plumbing is collateral, funding, clearing, and dealer balance sheets. When plumbing clogs, prices gap. So what do I do with this as an investor or trader? I respect leverage like a loaded tool. I remember that liquidity is not a constant. I assume correlations can change regime. A regime shift is when the market environment changes in a way that breaks prior relationships, like moving from low inflation to high inflation, or from stable funding to funding stress. I treat models as aids, not authorities. I size positions so I can be wrong and still stay in the game. I diversify by true drivers, not by ticker symbols. I keep a buffer, cash, time, optionality. Optionality is the ability to wait and choose, rather than being forced. And I watch my own mind. When a strategy feels too smooth, I ask what I am selling. When everyone agrees, I ask what happens if we all need the exit at once. When my P&L looks stable, I ask what the left tail looks like. The left tail is the bad extreme outcomes. LTCM is not a story about dumb people. It is a story about smart people who underestimated the combination of leverage, liquidity risk, and human herding under stress. It is a story about the difference between being right eventually and surviving until eventually arrives. If you remember one principle, let it be this. In markets, the first job is not to be right. It is to stay solvent when you are wrong.